Here's a detailed summary of JetBlue's 2025 Q2 earnings call. Introduction and CEO's remarks. Joanna Geraghty. JetBlue Airways reported a modest operating profit for the second quarter of 2025, exceeding guidance across key metrics despite a challenging macro environment. CEO Joanna Geraghty highlighted strong operational performance and significant gains in customer satisfaction, with Net Promoter Score, NPS, up double digits year-over-year. Demand stabilized and then accelerated through the quarter, with strength carrying into July, though recent weather and air traffic control disruptions have impacted operations. A key milestone was the DOT's completion of their review for Blue Sky, JetBlue's collaboration with United Airlines. This partnership will allow customers to book and redeem TrueBlue points across both networks via traditional interline agreements, and United will transition its distribution of non-flight ancillaries to JetBlue's Paisly subsidiary. Blue Sky is expected to contribute an incremental $50 million in EBIT through 2027, and JetBlue is increasing its JetForward EBIT target to $850 million to $950 million through 2027 to reflect this. JetBlue also reported improved aircraft on the ground (AOG) forecasts due to Pratt & Whitney GTF issues, enabling them to resume capacity growth in 2026 and improve their unit cost trajectory. JetForward progress and financial highlights. JetForward EBIT. JetBlue realized $90 million in EBIT in the first half of 2025, building on $90 million in 2024, bringing the cumulative EBIT to $180 million. They remain on track to reach $290 million in JetForward EBIT benefit by year-end. Operational improvements. On-time performance was up 3 points year-over-year, and completion factor increased by 0.5 points, both industry-leading. These improvements contributed approximately $15 million in incremental EBIT in H1 2025 and are reflected in the double-digit year-over-year NPS increase. Network optimization. Redeploying capacity to core markets has shown positive early traction, with newer markets in secondary Northeast cities exceeding expectations, contributing $15 million in incremental EBIT in H1 2025. Products and perks. Preferred seating continues to exceed expectations, and a new premium credit card is on track to double full-year projections for acquisitions. Lounges are on track for JFK in Q4 and Boston in 2026. Enhancements to the onboard experience, including Even More, and the upcoming domestic first-class product in 2026, are also progressing. These efforts generated $35 million in incremental EBIT in H1 2025. Cost transformation. JetBlue is implementing around 100 initiatives focused on technology, customer self-service, disruption management, and fuel savings. This has driven $25 million in EBIT and marked their 7th consecutive quarterly cost beat. President's remarks. Marty St. George emphasized JetBlue's recognition by J.D. Power for first and business class customer satisfaction and improved rankings in economy segments. He reiterated the excitement around the United partnership, Blue Sky, highlighting its 3 key value drivers: increased choice for TrueBlue members, growth of the loyalty business, and acceleration of the Paisly business. Financial metrics and guidance. Revenue. Total revenue was not explicitly stated, but unit revenue, RASM, declined 1.5% year-over-year in Q2, which was 2 points better than guidance. Close and bookings, within 14 days, increased 7% year-over-year in May and June. Premium cabin, loyalty, and transatlantic segments showed resilience. Q3 2025 outlook. RASM, expected to be down between 6% and 2% year-over-year. This guidance reflects strong peak demand, elevated close and bookings, weaker troughs, and a significant comparison impact from prior year benefits like CrowdStrike, 1 point, and the Easter shift/Newark disruptions, 2 points, in Q2. Capacity, ASMs expected to be down 1% to up 2% year-over-year. Operations. Guidance assumes a more typical operating environment for August and September, after facing weather and ATC disruptions in July. Full year 2025. CSM ex-fuel, expected to be up 5% to 7% year-over-year, maintaining initial guidance despite lower capacity. This reflects strong operational execution and cost reduction programs. Interest expense, unchanged at $600 million. Capital expenditures, forecasted at $1.2 billion, slightly down from prior guidance. CFO's remarks. CFO Ursula Hurley confirmed a modest operating profit for Q2, a step towards sustained profitability. Key points include fleet plan adjustments, GTF AOGs. The forecast for aircraft on the ground due to GTF issues has improved materially, averaging fewer than 10 AOGs in 2025 and expected to resolve by the end of 2027. This allows for a return to capacity growth starting in 2026. A 320 restyling. Pause restyling of 4 aircraft due to the improved AOG forecast. XLR sales. Decided to sell 2 upcoming XLR deliveries due to fleet cost considerations. E190 retirement, ending E190 flying at the end of summer, simplifying the fleet to A220 and A320 families. Binding sale agreements are in place for all 25 owned E190 aircraft and engines. Liquidity. Ended Q2 with $3.4 billion in liquidity, 37% of trailing 12-month revenue, exceeding their target. Q2 cost performance. CSM ex-fuel was up 6% year-over-year, beating guidance due to better completion factor and timing shifts in fleet transactions. This marks the 7th consecutive quarterly cost beat. Q3 CSM ex-fuel, expected to be up 4% to 6%, with maintenance and crew member wages as primary drivers. July's operational disruptions contributed a 1-point headwind from overtime and disruption expenses. Fleet transactions, mainly the gain on sale of E190s, provide a 2-point benefit. Fleet transaction benefits. A full-year gain from asset sales is expected to be 1.25 points of CSM ex benefit. Q2 included a 0.5-point gain, and Q3 will include a 2-point gain from these transactions. Key financial metrics summary. Revenue. Not explicitly stated, but RASM declined 1.5% YY in Q2. Profit. Modest operating profit in Q2. Gross margin. Not explicitly detailed, but focuses on EBIT improvement. Management forecasts. Jet forward EBIT. Target increased to $850 million to $950 million through 2027. Q3 2025 RASM, down 6% to 2% YY. Q3 2025 capacity, down 1% to up 2% YY. Full year 2025 CSM ex-fuel, up 5% to 7% YY. 2026 onwards. Low single-digit capacity growth anticipated. Significant risk factors, uncertainty in the macro environment, and booking behavior, close-in bookings. Weather and air traffic control disruptions impacting operations. Continued Pratt & Whitney GTF engine issues, though improving. Industry capacity and competitor. Actions. Highlights. Modest operating profit and exceeding guidance in Q2. Strong operational performance and customer satisfaction, NPS up double digits. DOT approval for the United Blue Sky partnership. Improved GTF AOG outlook, enabling future capacity growth. 7th consecutive quarterly cost beat. Strong performance in premium, loyalty, and transatlantic segments. Paisly business showing strong EBIT margins. Lowlights. Continued RASM decline, though better than guided. Impact of weather and ATC disruptions in July on Q3 operations. The need to manage capacity carefully to avoid RASM dilution. Most important statements. CEO Joanna Geraghty. We made meaningful progress with JetForward and met or exceeded guidance across all key metrics. Despite facing an uncertain macro backdrop, I am pleased that we produced a modest operating profit. She also highlighted the Blue Sky collaboration with United as a significant milestone to accelerate JetForward and increase customer choice. CFO Ursula Hurley. The forecast for aircraft on the ground has improved materially. This will allow us to return to a more favorable unit cost growth trajectory, supporting our return to profitability and free cash flow generation. She also emphasized the seventh consecutive quarter we have achieved or beaten our cost guidance, demonstrating strong cost control. The call concluded with an overview of the company's financial health and operational improvements, expressing confidence in the JetForward plan to drive transformational change and return to profitability.